go and see the world and just show them what it really means to live life golden. Yeah, we're golden, baby girl, we're golden.
Good day guys, my name is James Gabriel Rosaroso, and today, let's talk about conceptual issues in cash flows. But first, let's discuss what are cash flow and cash flow estimation. Cash flow is the net amount of cash and cash equivalents being transferred into and out of the business. At the most fundamental level, a company's ability to create value for shareholders is determined by its ability to generate positive cash flows, or more specifically, maximize long-term free cash flow. While cash flow estimation is the most important and most difficult step in capital budgeting, this is used to determine the economic viability of long-term investments. If not reasonably accurate, no matter how sophisticated the analytical technique is, it can lead to poor decisions. So first of the 7 issues is cash flow versus net income. The firm's value is based on cash flows because cash is what firms use to spend or reinvest. The difference between the two is that income statement also takes into account some non-cash accounting items such as depreciation. The cash flow statement strips away all of this and shows exactly how much actual money the company has generated. Any changes to working capital of a project directly affects cash flows but not the net income. The second issue is timing of cash flows. It deals with cash flows exactly when they occur, but for simplicity purposes, we assume year-end cash flows. Now let's go to the third issue, incremental cash flows. A cash flow that will occur if and only if the firm takes on a project. They should be included in estimating cash flows. The fourth conceptual issue are replacement projects. These are projects where the firm replaces existing assets to A. reduce cost and / B. increase operational efficiency. The fifth issue are sunk cost, a cash outlay that has already been incurred and that can't be recovered regardless of whether the project is accepted or rejected. They should not be included in estimating cash flows. The second to the last issue are opportunity cost, the best returns that can be earned on assets the firm already owns if those assets are not used for the new project. They should be included in estimating cash flows. And for the last conceptual issue are externalities. These are defined as the effects of a project on other parts of the firm or the environment. There are 3 types of externalities. The first type is negative within firm externalities, also known as cannibalism. This occurs when the new products compete with old ones. For example, a Home Depot opens a new store that are too close to their existing stores. This takes customers away from their existing stores. Even though the new store has positive cash flows, its existence reduces some of the firm's current cash flows. The second type is positive within firm externalities. A new project can also be complementary to an old one, in which case cash flows in the old operation will be increased when the new one is introduced. For example, Apple's iPhone was a profitable product, but when Apple invested in complementary products such as the iPad, Mac, Apple TV, Apple Watch, AirPods, and many more, in order to create an ecosystem for Apple products that best coexist with one another. This did not only increase the iPhone sales, but also draws customers in to purchasing more products to work simultaneously. And last but not the least, environment externalities. The most common type of negative externality is a project's impact on the environment. This refers to the economic concept of uncompensated environmental effects of production and consumption that affect consumer utility and enterprise cost outside the market mechanism. A firm can boost up goodwill when spending for the environment. And that's all for today, and thank you for listening.